Welcome back. It's Rahul, and today we're tackling 3 big financial headlines that could hit your wallet. Gold prices smashing past Rs 96,000, the Sensex tumbling 800 points, and a proposed 5% US remittance tax. These aren't just numbers, they affect your savings, investments, and family budget. Whether you're buying jewelry, watching your stock portfolio, or relying on money from abroad, these shifts matter. I'll break down what's driving these changes, what they mean for you, and the smart moves you can make right now. Let's cut through the noise and get straight to the practical impact, starting with gold. Let's dive in. Gold has rocketed past rupees 96,000 per 10 grams. A global surge, not just an Indian story. What's driving this? 3 big factors: a weakening US dollar, global geopolitical tensions, and massive central bank buying. A weaker dollar makes gold cheaper for buyers in other currencies, boosting demand. Geopolitical uncertainty pushes investors towards safe haven assets like gold. Central banks are stockpiling gold to diversify reserves, adding long-term demand. So, what should you do? If you have a gold loan, now's the time to check if you can get better terms or a top-up. Your collateral is worth more. Planning to buy gold for a wedding or investment? Don't rush in all at once. Stagger your purchases to average out the price. Think of it like a SIP for gold. For long-term investors, consider sovereign gold bonds, SGBs. They offer interest, tax benefits, and no storage hassles. SGBs are government-backed, pay 2.5% annual interest, and capital gains are tax-free after 8 years. Don't get swept up in the hype. Evaluate your needs and diversify your investments. High gold prices mean your existing jewelry is worth more, but new purchases will cost you. If you're buying for tradition, consider booking schemes but read the fine print. Remember, gold is a hedge, not a guarantee. Prices can correct. Watch for changes. If the dollar strengthens or tensions ease, gold could dip. The current rally is a signal to act smart, not impulsive. Use this surge to review your finances, not just celebrate or panic. Diversification is still key. Don't put all your money in gold no matter how shiny it looks. Stay informed, stay strategic, and make gold work for your goals. Next up, the Sensex shock. The Sensex just dropped 800 points, a sharp reminder of market volatility. What triggered it? Rising US bond yields made American debt more attractive, prompting foreign investors to pull money from Indian stocks. When FIIs sell, it puts pressure on the market, especially in sectors like tech and high-growth stocks. For investors, the key is not to panic. Corrections are normal and often followed by recoveries. Don't sell in fear. Review your goals and stick to your plan if your horizon is long-term. Use dips as opportunities. If you believe in your investments, consider buying more at lower prices. Systematic investment plans, SIPs, help you average out costs and remove emotion from investing. Diversify your portfolio across asset classes and sectors to cushion against shocks. Rebalance if needed, especially if you're overexposed to one sector. Remember, volatility is part of the market's natural cycle. Focus on quality stocks and funds, not short-term noise. If you're unsure, consult a financial advisor for guidance tailored to your risk appetite. The Sensex drop is a lesson in discipline. Don't let headlines dictate your strategy. Understand the global triggers, but control what you can. Your asset allocation and your reactions. Stay systematic, stay diversified, and keep your eyes on your long-term goals. Market dips are temporary. Your strategy should be built to last. Don't chase trends. Stick to fundamentals. Use volatility to your advantage, not your detriment. The Indian growth story is long-term. Don't lose sight of it in a single bad session. Now let's talk about that proposed US remittance tax. Washington is considering a 5% tax on remittances sent from the US to countries like India. If passed, sending $1,000 could mean your family receives only $950, a real hit for many households. The US says it's about revenue, but for Indian families, it means less money for essentials, education, and savings. If you rely on remittances, consider transferring funds sooner if you have big expenses coming up. Beat the tax if you can. Always compare transfer services. Fintech platforms often offer better rates and lower fees than banks. Every rupee saved on fees or exchange rates helps offset potential new taxes. Once funds arrive, put them to work. Use high-yield savings or short-term investments to grow your money. Keep records of all transfers for tax and financial planning. Stay updated on the bill's progress. Policy changes can happen fast. Don't use informal channels to avoid taxes. The risks outweigh the savings. If the tax passes, review your remittance strategy and optimize for cost and efficiency. For now, awareness and planning are your best tools. Policy changes abroad can have big effects at home. Be proactive, not reactive. If you're sending or receiving money, stay informed and flexible. The remittance tax isn't law yet, but it's a wake-up call to review your finances. Watch reliable news sources for updates and act quickly if needed. Optimize your transfers now to minimize future impact. Let's wrap up with a quick recap. Quick recap. Gold is soaring, so review your loans and stagger purchases. The Sensex is volatile, so stay disciplined and diversify. And a US remittance tax could be coming, so plan transfers early and compare options. These aren't just headlines. They affect your money and your future. Use today's insights to make smarter decisions and protect your finances. If this helped, hit like, subscribe, and the bell for more updates. Drop your gold price prediction in the comments. I want to hear your take. I'll be back tomorrow with more headlines and wallet tips. See you then.